Hello traders, and welcome back to another survival guide. In today's discussion, we're going to dive into the world of technical analysis, so if that's something that you love, well then this one is for you. We're going to cover a pattern called the ascending triangle formation. Generally, this is considered to be a bullish formation. That means an extension of a trend, but we'll talk about all of that and more. We're going to cover what it is, how to find it, and how to trade it. So sit tight, stay tuned, and let's learn about a pattern that you could implement at the very end of this video. One of the biggest advantages of the ascending triangle pattern is that it's very easy to identify in the charts, at least relatively speaking, in addition to being a very reliable continuation pattern in most traders' opinions. Now, with this being said, we should still always use outside layers of confirmation with any analysis that we're garnishing from the market. But let's start off with the what. What is the ascending triangle pattern? It's frequently referred to a continuation pattern because the price breakout typically occurs in the same direction as the prevailing trend, which was in place before the triangle's formation. The ascending triangle suggests that bulls are dominating the market as the price of the security continues to record higher lows. I did say higher lows. The pattern is considered active once the price breaks out of the triangle following the direction of the ongoing trend. Here we have the ascending triangle, which is on the left, in comparison to its complete mirror image brother, the descending triangle on the right. If we completely inverse an ascending triangle, this is what we're given, a descending triangle. When we take a look at the image on the left, we can see that the highs are finding resistance at the same level, giving us a flat line across the top. Meanwhile, the lows are progressively getting higher, giving us this upward slope of our lows. Ultimately, this can't last forever as price gets squeezed into a corner and it will break out. When it breaks out, we want to see this top area of resistance function as an area of support for our bullish confirmation of the future bullish progress. Now, if we inverse absolutely everything we just said, all of that would hold true with the expectations of the descending triangle formation. With the descending triangle, we want to see price falling downwards before entering into this triangle pattern. Now, instead of the top line being flat, it's going to be the bottom line, which is going to be the area of support holding constant, a nice horizontal line on the bottom side where the lows are getting stuck at the same price point. Meanwhile, with the descending triangle, the highs are progressively getting lower as we squeeze into the corner. When we finally break out of the flat line, which is going to be the support, we will then expect to see that area of support function as an area of resistance. When traders first begin looking for and trading the ascending and descending triangle formations, it's very common for them to get caught off guard by what we call a rising and falling wedge. So we're going to display exactly what both of these are. On the left-hand side, we have the rising wedge. This pattern appears when the price rises with pivot highs and lows converging towards a single point, which we refer to as the apex. The biggest obvious sign of a wedge versus an ascending triangle is the fact that the highs are actually sloping upwards instead of getting stuck at a centralized point of resistance like we have with an ascending triangle. The other big difference here is with the rising wedge, we expect price to fall down after it breaks out. And naturally, the exact opposite is going to be true with the falling wedge. With the falling wedge, once again, we don't have a flat line of support like we do with the descending triangle. And when price finally breaks out with the falling wedge, we actually expect price to begin rising. At the end of the day, there's a lot of ways that we can further confirm the information that we're gaining from the ascending triangle pattern or the descending triangle pattern. With the ascending triangle pattern, an example of this would be that traders oftentimes like to wait for the break to happen, and once that resistance line has broken, they'll wait for price to come back down to that broken area of resistance and wait for it to test and show support. At that point, they would look to go long. The exact opposite could be done with the descending triangle pattern in the way that once that area has broken the bottommost area of support, they would wait for price to come back to that broken area of support, function as resistance, and then look to go short. There's a number of ways to do things, and it's going to be up to you to decide what works best for your particular trading style. But until next time, I wish you the best of luck in finding the ascending triangle pattern.